Hi, I'm Chris Miglino, and I am here at the world-famous Roth conference down in Dana Point, California, and I am here with Clive Kinross from Propel Holdings. And Clive, thank you very much.
Thank you. Thank you, Chris. Appreciate it.
Appreciate it. All the way from Toronto, coming down, getting some warm weather down here.
You got it. You got it. You know, don't tell anybody. I told them I'm here for all the amazing investors we're going to be meeting.
Well, that too, obviously, always at a Roth conference. So tell us about the business. You guys are in the lending business.
Yeah.
And I noticed that you guys are doing direct lending yourselves and providing platforms to other financial institutions to do lending. So give us a look.
Yeah, no, fantastic. First of all, again, thank you so much for having me. And this is a business that I started with my three co-founders just over 12 years ago. The business is focused on providing access to credit to underbanked and underserved consumers, initially in the United States. Today we're in Canada and the US. It's a big global opportunity comprising around 70 million consumers on both sides of the border, let alone the global opportunity. And we do that all on our proprietary technology platform. All of it is world-class, built in-house with a big AI infrastructure at the end of the day. And we have a variety of different products that we offer to underbanked and underserved consumers depending on their risk profile at the end of the day. Some of them we do on our own balance sheet with our own licenses. And in other instances, really for the last 4 or 5 years or so, we've been able to leverage our technology and AI infrastructure by providing banks with the ability to originate loans to underbanked and underserved consumers across a range of different products.
So what does that mean? What is the underbanked and underserved?
Yeah. So the underbanked and underserved consumer, in a nutshell, are folks who cannot go into a bank, a mainstream bank or credit union, and get access to credit. And frankly, we're in an environment now where many consumers who otherwise might be able to get access to that type of loan just can't do it. They can't do it.
Now, does that mean their credit score is low, or they just don't have access to a banking institution?
No, it's the format. So if their credit score doesn't provide them with access to those loans, banks have shut them out. You can't score these folks based on a FICO score because none of them will look particularly good,
right.
Which is one of the reasons that we've developed our proprietary AI to be able to assess who of them could qualify for a loan and be able to make their payments.
So what else do you look at? What else does the AI look at in when it's making that decision? I guess it has so many consumers that it can look at and say, this person, although they may have a low credit score, is likely to continue to pay us back.
Yeah, I think the first thing that we need to do is speak about what would a typical traditional lender look at. A traditional lender would look at a FICO score, look at the consumer's income, provided they've still got a heartbeat. If they've got a FICO score above 800, they'd qualify for credit.
Right.
It's not a particularly complex thing to do, and you certainly don't need AI. With our customers, if you look deeply into their credit scores, they've got missed payments. Some of them are thin files. In other words, they don't have a lot of credit history over there. They've got bounced checks. They've potentially moved around across different employers over time. So they've got spotty credit profiles to begin with. From our perspective, what we ask them for is we ask them for their banking information. We ask them for their employment information. And we run all of that through our sophisticated AI models to make a determination as to whether we could lend to the consumer or not. Lots of variables like email address, for example, is a big determinant as to whether they'll repay their loan or not, just coupled with a bunch of other data as well. So I'm not going to tell you that we would ever disqualify anybody based on that piece of information alone or make the loan based on that information, but that's certainly an important determinant. Their cell phone carrier, how long they've had the cell phone for, have they missed payments against it? It's another very important variable. As are many, many others. But what all of that allows us to do through our collective programs is take in about 40 to 50,000 applications each and every day, and in a matter of between 5 or 10 seconds, render a decision to the consumer as to whether they qualify or not.
40 to 50,000 applications every day?
Every day.
Wow.
Yeah.
And how much of that, out of 40 to 50,000 that gets submitted, how many actually are able to get funds?
So there's a couple of variables that we look at. First of all, we're constantly increasing the universe of partners that we work with who ultimately send us the application traffic. It's a big driver of growth. The other thing that we're able to do is what we call accept rate. So what percentage of customers who apply do we accept? And it's going up all the time for a few reasons. First of all, we have more and more products. So between us and our bank partners, we could appropriately risk price those consumers to give them the appropriate product. In addition to that, because of our AI, ultimately, we could accept more consumers than we would otherwise accept without taking on additional risk or higher default rates than we otherwise might. So in this environment, roughly, anywhere from 8 to 12% of those consumers would pass our underwriting. It's a big delta. We're like the banks. Like the mainstream banks and credit unions, our underwriting and our bank's underwriting is also relatively tight right now. So we're probably closer to the 8 to 10% than we are to the 10 to 12%. And then of those that are accepted, we still need to convert those into loans. So we will then convert anywhere from, call it 25 to 35% of the customers who pass our underwriting into a loan. And part of the challenge with the business from an operational perspective is constantly driving up both of those percentages without taking on additional risk. And obviously, you could see from our results that we've proven our ability to do that very, very consistently. The business has been public since 2015. The business has been profitable since 2015. We went public in 2021 on the back of about 130 million in revenues and 7 million in profits. In just 2 years, we quadrupled profits, with revenues growing to 316 million.
So what for the year, the revenues are around
316. That was a 2023.
That's fantastic.
Yeah.
What's the operating income off that, or the net?
So we have an IFRS income, which is a very punitive way of accounting, but that was about $28 million US.
Good.
And our adjusted net income, which we believe is more reflective of the business, was $36 million. We've also come out with guidance for the year, and the guidance for the year assumes roughly 40% top-line growth at the midpoint, with the bottom line growing in excess of 50% at the midpoint, and all of that growth is organic.
And that will, the 40% will put you where? Where does that put you? It's you did one.
The 40% puts us, give or take, in the mid 400s, just south of the mid 400s.
Fantastic. So it's a great business and a lot of money coming to the bottom line. The AI is obviously an important component here.
Critical component. Yeah.
Well, when you're doing that, how much of the when you're doing the platform, right, and the banks are using you, what's the difference of the business model, right? Like when you're the underwriter, you're taking the risk and you're taking the profit of that. What does the business model look like when you're providing the service to your partners with the white label tool?
It's a great question, and we call that lending as a service, where we are literally servicing the loans, but we're not taking any economic interest in the loans. And typically, we will mark up the various aspects that we service on behalf of the banks. So there'll be an increased charge on the underwriting. There'll be an increased charge on the marketing. And there'll be an increased charge on the servicing, which does a couple of things. First of all, it means that from day one, the loans that we're originating pursuant to our lending as a service models are profitable from day one. In addition to that, the margins on that business are larger than in our typical lending business, and that's
less risk too.
And less risk at the same time.
Right.
So typically, if you said to me, how does the economics break down between us and whoever the party is that's ultimately taking the risk for that loans, the lion's share of the loan economics will go to them, with a smaller component going to us. But it's in such a vast market, and it is still profitable with each loan that we do, that it ultimately could grow into a business that dwarfs our current outcome.
Are your partners that are using your software to do this, finding that the loans that they're making using your AI are performing better even than maybe just stuff that they're letting off of just a traditional credit score?
They have to, because if they don't, they are not obligated to keep purchasing the loans.
Right.
At the end of the day, I think it's a little bit of a misnomer to assume that we're not taking any risk, even though we're not directly taking any risk. The risk that we're taking, and while we need to be absolutely vigilant, assessment of risk and underwriting, is that if these loans don't perform, the purchases will go away. Right. And there's been a lot of fintechs over the years that have been valued off of a revenue multiple, not a profitability multiple, which is something else that I don't understand. And there's a misalignment between them and the purchasers of these loans, because they're incented to put as many loans as possible on their books. And what happens is when you do that is you oftentimes loosen your risk criteria. And the purchasers don't end up making the returns that they otherwise were promised or should make, and they go away. We're mindful of that, so we won't let that happen.
Does it happen that since these are what we've deemed as the underserved community, can the interest rate charge to that audience be a little bit higher? And if the AI is reducing the risk because you're saying that these people are likely to, pay their bills, it actually could turn out to be a better financial model for the banks to actually, and for yourselves, to lend to these people? Because if you can eliminate, you're reducing the risk with the information you have, and you're increasing the percentage because of the perceived risk of this individual, it's actually a better margin business.
Look, these are consumers who don't have the best profiles, the best risk profiles, and they've been pushed into products that are really, really suboptimal from their perspective. So from our standpoint, because of our AI and technology, we can provide them products that are way better than they would otherwise qualify for. But at the end of the day, they would still be considered riskier consumers. I would make, and that's your question, Chris, I would make the distinction between riskier consumers who've got sporty credit profiles and risky business. Our business to us is not risky business, and I would argue that those lenders that are providing unsecured loans to prime and super prime consumers operate with riskier business models than we do. And by the way, everything I'm saying is backed up by data and lots of history over here. To the extent there is a downturn in the market, and by the way, we don't see that anytime soon. If anything, consumer sentiment's on the way up, unemployment's as low as it's ever been, inflation seems to be coming under control. So in many respects, we're in a Goldilocks scenario, but should that change, our segment of the industry is exceptionally resilient through any types of economic cycles, whereas the prime and super prime lenders don't necessarily have the same operating performance in challenging economic times as our industry does.
It's a fascinating business. Be sure to check it out. PRL is the symbol. Sit on
Toronto Stock Exchange.
Toronto Stock Exchange, but everybody can trade the PRL.
Everybody can trade it, and we're very, very excited. And the last thing I will say is, on both sides of the border in North America, which is where we're operational today, now that we're approaching the end of Q1, just a little bit of insight into what we're seeing. We're seeing continued resilience. It's really pretty fascinating and amazing just how resilient consumers are on both sides of the border.
Well, best of luck in getting to that $400 million in revenue, and continue to grow that business at 40% a year. And I'm sure that everybody will be glad that they bought the stock from seeing it here. So thanks for your time. I appreciate it.
Appreciate it.
Thanks very much.
Thanks, Chris. Thank you.